hopefully now everyone is able to access the slides in a language they can understand and see or hear my words in English, French, or Spanish. So allow me to formally welcome you to the event. We're very, very excited to begin sharing with you the key proposals in the second exposure draft of INPAG, International Non-Profit Accounting Guidance, so that you can give us your feedback. My name is Samantha Musoke. I am the IFR for NPO Project Director for Humentum. I'm based in Uganda, and many of you have received an invitation or an email from me, so thank you so much for your positive response. Joining me today, I'm delighted to welcome Karen Sanderson, who's the INPAG Technical Director at CIPFA, the Chartered Institute of Public Finance and Accountancy. Karen and I work together very closely to ensure the guidance is developed with appropriate technical rigor, informed by stakeholders' input. We're also joined by Philip Trotter. As an associate with CIPFA, Philip has been instrumental in drafting the text for the topic that we'll be covering today. So we have exactly the right person in the room to answer our questions and add colour and context for us. Welcome, Philip. I hope that many of you have attended earlier events and have some awareness about IFR for NPO project and about INPAG. So rather than introducing the project and Exposure Draft 2 at every webinar in this series, we have two videos that will give you the necessary background. And I'm trusting that you've already watched those because you've had the links in emails and web pages. The first is a background about the project in general, and the second is an overview of Exposure Draft 2. And links to these videos in different languages are going to be added into the chat now. In case you missed it, you can watch those after the event. So today's webinar is part of a series covering the main themes in Exposure Draft 2. Today is the first. You can register for future events and you can view the resources from previous ones from the project website at ifrfornpo.org/events. Now, we are incredibly keen to hear your thoughts and feedback. The perspective of people working in the sector, as well as donors and auditors and the accounting professional around the world, are really essential to make sure that the guidance is relevant, that it's user-friendly, credible, and fit for purpose, so that it can be widely adopted. Now, this project started way back in 2019, and we have already received input from experts and advisors to reach the point of having this second exposure draft to share with you. So the purpose of today's 1-hour webinar is to explain these proposals and for you to have the opportunity to ask questions, seek clarifications, and also share your comments, opinions, and feedback. At the end of the webinar, we'll also tell you how you can submit a formal response to the consultation. So here's the flow for our session today. We've already finished the introduction. What we're now going to do is watch a video on YouTube that we have prepared in advance to explain the proposals. There are links now coming in the chat to the same video. It's in English, Spanish, and French. Now, this way we can each watch the video in a language that we understand in our preferred language. So I know this is a bit strange, leaving Zoom, going to YouTube, and then we'll come back. The video is, I think, 18, 19 minutes. It's very slightly different lengths in different languages. As you watch the video, please think about how the proposals apply in situations that you're familiar with, in your context. You can type any questions that come to mind in the chat, in the Zoom chat, as you go along, as you're watching the video. Please use the Zoom chat for questions in English and use the Microsoft Translator app for questions in French or Spanish, or indeed any language that you've logged into the app with. After that video has finished, we'll all come back into Zoom and we'll respond to selected questions. Now, due to the size of this event and all the language considerations, we will only be able to take questions and comments in writing. Okay, so we're now going to go to Zoom, to YouTube, to each watch the video ourselves. I haven't been able to keep an eye on the chat, so Brian, I don't know if there's any problems or questions or if that's okay. Great, so please open up that link to the video in your own language, watch it there, and we will see you back here afterwards. I'm going to pause the recording, see you shortly. Great, so thank you so many of you for submitting questions. I'm going to start with one that came in advance as well, which is really, the guidance is supposed to be for smaller and medium-sized NPOs, non-profit organizations. Philip, this seems very complicated. Lots of new terms, lots of complication. This is quite a lot to get your head around. Why is it so complicated, Philip?
Okay. Hopefully I'll assuage those concerns. We do appreciate there is a lot of new terminology here. And there has been some questions coming in about jurisdictions that already have guidance. And part of this new terminology is because there are a lot of terms used in a number of jurisdictions that sound the same, but are used in different ways. So unfortunately, new terminology that can be internationally applicable it's just part of the nature of the beast of what we're creating. At its heart, though, I think the common model we've developed is actually relatively simple. First, you need to decide whether the transactions are grants and donations or are actually commercial revenue or procurement. And here you look at whether the provider of resources is ultimately getting something directly of equivalent value in return for those resources. Ultimately, who is the real beneficiary of this transaction? Is it the provider of the resources, the recipient of the resources, or another entity or individual? Once you do know that it's a grant or donation, and secondly, you need to consider whether the arrangement is enforceable and what the rights and obligations on the parties to that arrangement are. Now, in our terminology, to be an enforceable grant arrangement, the arrangement needs to be enforceable through what we've called legal or equivalent means, and both sides need to have identifiable rights and obligations. Now, in an enforceable grant obligation, we have a special type of obligation. In an enforceable grant arrangement, we have a special type of obligation called an enforceable grant obligation. And this is an obligation on the recipient of the resources to either achieve a specific outcome, carry out specific activities, use the resources internally for a specific good or service, or transfer a good or service to a recipient. Now, on the flip side of that, we also have special types of rights called grant fulfillment rights. And these are rights that the provider of resources has effectively to see those enforceable grant obligations met. So if the arrangement is a grant, it's enforceable, and both sides have these special rights and obligations. It's an enforceable grant arrangement. And under these arrangements, our proposal is that revenue and expenditure are recognized as each side effectively fulfills those obligations. So it's effectively like a performance approach. If the arrangement is a grant, but both sides don't have rights and obligations, and or the agreement is not enforceable, then we've called that an other funding arrangement. And under these arrangements, revenue and expenditure are generally recognized as resources are transferred and received. I don't want to call it cash accounting because it's not, but in my brain, one's an accruals-based performance approach and the other's more of a cash-based transfer and received approach. Now, there is a slight complication because these other funding arrangements, there may still be some constraints on how a recipient can use resources, but these aren't really sufficient to create that enforceable grant obligation. They aren't specific enough. There isn't a specific activity or a specific outcome mentioned. So you may have a constraint that, say, requires resources to be spent on a broad area of an NPO's activities, but if it's not specific, it's not going to create a present obligation. So an obligation that exists at the relevant accounting date. And if this present obligation doesn't exist, then there isn't a reason for it to follow this sort of performance-based rights and obligations approach. It will then be resources being transferred, and then only if in the future the constraint isn't met might a requirement to either repay or a liability occur. So I appreciate there's a lot, but if you get it into your mind, one's we have an enforceable thing where both sides have rights and obligations, and you recognize revenue expenses when they're met. And the other side is of a funding arrangement where actually you're recognizing as resources are being transferred or received. Those are the two core elements of the model. I appreciate then there is a lot of complication behind that, because you might have some arrangements that may have almost parts of both within them. You have arrangements that involve capital grants, and you have the whole nature of actually an asset being developed, and how does that fit in? But at the heart, we've got two possible arrangements and two distinct ways of accounting for them. So hopefully that's helpful.
Brilliant, thanks, Philip. So maybe not quite as complicated as it looks at first sight. I thought it'd be quite good just to, so that people know how to listen to this. There's a couple of queries that have come in about in my jurisdiction. So I've got people talking about in the UK where we have a charities SORP that governs how charities do accounting. We've got somebody from Australia saying we've got guidance in Australia. First thing to say is that both UK and Australia and many other countries are on the technical advisory group that's guiding this process and having input. But what's the relevance for this? If somebody's dialing in from UK or Australia or somewhere, another country that has existing guidance, how should they be listening to this?
So the IFR for NPO project and the guidance we are looking to develop is going to be an internationally applicable set of accounting guidance and financial reporting guidance for non-profit organizations. We, as a project, are not going to impose this on anyone. We have no rights to require any entity in the world to apply this guidance. But what we think we are creating is something that will improve transparency, consistency, accountability, and be applicable worldwide. Now, our hope is that jurisdictions will take up this guidance and will apply it to NPOs within their sphere of authority. That's a sphere of authority that we don't have. Now, in order to ensure it is as internationally applicable as possible, as you've mentioned, Sam, we have a broad range of international groups. We have a technical advisory group that does the nitty-gritty accounting guidance. We have a practitioners advisory group that looks at whether actually the guidance we're developing is going to be applicable in the real world and what the impacts will be for NPOs and the users of those statements. We have a number of country champions who are working within their own jurisdictions to increase awareness of the project and to bring on more people in meetings like this so we can get the broadest range of guidance as possible. So we're not imposing this on anyone. We hope it will be useful for everyone, but it will be for individual jurisdictions over time to determine whether they would like to move to this or not. So in answer to say, the Charity Commission, yes, UK trust law, UK charity law, it may be decided that actually this guidance isn't the right fit for UK charities. It might be a good fit for UK nonprofits that are not charities, because that specific trust law might not impact on them. It might, over time, as we develop the guidance further, become a better fit for certain jurisdictions. But the way to look at this is this guidance right internationally, and would it benefit your jurisdictions over time? I think would be the way I'd look at it.
Brilliant, thank you. So no panic. This isn't about to suddenly impact you tomorrow. I think, from my view, I've lived in Uganda for 21 years, and we don't have guidance in Uganda that's specific, and it would be so helpful to have some. So this is an international project. We're trying to come at it from an international point of view, but each country will have that. So don't panic. but let's come at it from something that's going to help everybody. Super. Right, there's lots and lots of questions. So let me start with this one from Tim Moss. Is the idea that we've got this mirror between the way a grantor does the accounting and the way that the grantee does the accounting? Like, are they sort of supposed to be equivalent? And would you expect the grantor and the grantee to coordinate to make sure that they've got that on an individual basis?
Okay, very good question. I think forgetting about financial reporting standards, you would hope that a grantor and a grantee will be coordinating the development of grants and how they would report how they're performing and how the individual is being monitored anyway in an ideal world, because I think that's just good financial management, that's good financial practice. If both are applying INPAG and then both have created a grant that is enforceable, that has rights and obligations within it, then ideally, yes, you would expect, if both are applying the guidance to the same arrangement, that they would come to a similar view as to how that arrangement should be accounted for. Ultimately, though, this is principles-based, it's not rules-based, and it's up to the individual entity to determine whether it deems that a arrangement is an enforceable grant arrangement or another funding arrangement. But if you are looking at this from the sort of broader financial management view, and you're both applying INPAG, then you should be coming to a similar conclusion as to how an arrangement looks. You will have set up a structure that is legally enforceable. You will set up a structure that has very clear rights and obligations on both sides, and you will have very clear monitoring and reporting guidelines within that to show when those rights and obligations are being met.
Brilliant. So something that a lot of people are familiar with, and this question has come up, is this idea of restrictions. So this is, we've got lots of new terms in the video, but a term that people really do sort of use a lot is restrictions. So can you explain a bit, are they the same thing, an EGO and a restriction, or what's the difference? How do they interplay with each other?
So an EGO is effectively a sort of specific undertaking, I think is probably the best way to look at it, that has been given by a grant recipient within an enforceable grant arrangement that would require it to use resources in a specific manner. We do use restrictions slightly differently in another part of INPAG, so we haven't said restrictions, and we do base our guidance on internationally applicable standards, be that IPSAS or IFRS for SMEs or IFRS wherever possible. So we've used this term undertaking rather than restriction, because it's sort of showing that, look, we're almost promising that we're going to deliver something. What is the thing that we are going to deliver? It could be a broad range of things. It could be a specific outcome. It could be a specific activity. It could be to use it for a specific internal service or good, or it could be to transfer it outside to another, I don't like the term, but a beneficiary within the community. So in a way, that is a restriction in the sort of common English usage of the word, because I, as a grantee, can only use those resources in a specific way. Now, those have to be specific. There might also be these things that we've called constraints that are also a form of restriction, because say I have to spend my grant on education. I'm an NPO that does education work, and I've been given some money to spend it on education. But that education is a very broad category. I'm not specifically saying I'm going to improve access to school in this jurisdiction by 20%. I'm not going to specifically transfer money to spend on school fees for learners who can't afford them. That would be an EGO. Just spending it on education is a constraint, so it's effectively a restriction, but it's not specific enough when I receive those resources for a present obligation to exist. So it is tricky, and again, it's where we get back to the need to create new terms, because restriction, condition, performance obligation, promise, they're all used in slightly different ways in many jurisdictions. So trying to have a new set of terminology that we can all agree on will hopefully allow people to coalesce around the correct accounting and financial reporting.
Brilliant. Thank you. That's fabulous. So there's a few questions here about principal agent. It's come up, quite a few different people have talked about it. So one is somebody's asking about the prime and sub partner language. If we want to do prime and sub, which is a sort of language that's common in the sector, why would you use agent principal? And I had another question that was submitted in writing beforehand, which is if you outsource your financial management to like a grant management agent and the money goes directly to them, would you recognize that gross? Are they an agent or are they your supplier? So it'd just be good to have some clarity on this principal agent conversation.
Okay. Principal agent is the use of the terms is because it's relevant to other parts of INPAG and other NPOs that is not just in the sort of grantor, subgrantor, grantee world. So there is in international accounting standards an accepted use of the terms principal agent for whether you're a principal in a transaction or an agent in a transaction. And that's the terminology that we've used in the standard. What we do have in INPAG is a range of sort of sub-guidance behind the authoritative guidance, so implementation guidance and examples. And and it's very useful feedback, if attendees think that actually using the different terms in that would be useful, so it becomes more alive for the sector, specifically when we're talking about these very individual things, being grants given and grants received. That's something we could definitely use. But the sort of heart of the principal agent question is, to what extent are you controlling the economic resources in the transaction, or to what extent actually are you just serving as a conduit for another entity to achieve its goals rather than your own? And hopefully the sort of discussions and we've had with the technical group and the practitioners group, the guidelines that we have, where if you are the principal, so you're in control of the resources, so you have to account for them because they are your resources, so you'd account for them following this guidance, and you would show all of the revenues and costs and assets and liabilities associated with them, as opposed to being an agent where actually this transaction is not really yours. You're almost serving as you are serving as a conduit for one reason or another for another entity. You're effectively achieving that entity's goals on their behalf. You may pay or receive some income for that, but that transaction isn't really yours and shouldn't be reflected in your financial statements, because then that would be, it wouldn't be a true and fair view for users. That's another entity's grant, and that other entity is the one who's deciding whether those beneficiaries receive that grant or not. You are effectively serving as a way for them to achieve that. So showing that all of that transaction in your financial statements it just wouldn't be correct, because you as a reporting entity, that is not yours.
That's really interesting. And that could actually, the example that was given was like a sub-grant from a donor to, say, World Vision or an INGO that then sub-grants on to an implementing partner. And that INGO, the middle organization, has to report on all the transactions, probably on a line-by-line consolidation basis back to the donor. But that might be quite distinct from the way it reports grant expenses, or it's an agent in its general purpose financial statement. So it's quite important to see those as two separate things, right? And
it could depend on what the INGO has promised to the providers of the resources that have come to it. If it's subgranting, but ultimately, I think it was World Vision, the example, is the one responsible and runs the risk, and if those resources are misused, has to pay them back potentially to the grantor, then it's the principal. It then has another grant arrangement of its own further down. But if ultimately it is the one who is responsible to that grantor, then it could show all that transaction as a principal. What it would then have is further grant expenses of its own and further arrangements that it would need to account for. We do appreciate that practice in the sector, particularly around consortia, means that this could be quite difficult initially when you're looking at the arrangements to try and work out actually who's the principal. Am I acting as an agent here? Are others acting as an agent on my behalf? But hopefully what the accounting will do here is drive good proper financial management, because these are the things that ultimately, if you're at risk or if you do have control of resources, you want to be accounting for them. You want to know what your position is.
Brilliant. Okay, there's still quite a few different topics to cover, so I'm going to move us along. So one is on this idea of matching. Yep. We know that matching was thrown out as a sort of fundamental principle 10 years ago. You talked about a sort of, it's not cash basis, it's not matching, and yet there is an element in which we're recognizing income as in a similar way to expenses. So can you speak to that matching dilemma?
Yeah. So if we start, I appreciate there'll be a lot of individuals who'd love matching back. Being able to match expenses to revenue coming in would be great. The model's not based on matching. What the model's based on is you have obligations. Let's start with a more complex one, the enforceable grant arrangement. As a recipient of grant funding under an enforceable grant arrangements, I have obligations that I need to meet. Once those obligations are met, I will be entitled to the revenue related to those obligations. Now, those obligations will obviously cost me resources and expenditure, but it might take a while for that spend to ensure that the obligation is met, or it might all be in one go. What we're not doing, we're not matching revenue and expenditure. What we're saying is there will be expenditure that allows an obligation to be met. When that obligation is met, you are then entitled to recognize the revenue. But it could be, that could all happen in 1 year, and then it looks like you've matched. It could happen over multiple years, in which case you might have several years of expenditure until you're entitled to recognize revenue related to that obligation. So that's the slightly trickier one. For the other funding arrangement, because you can't enforce the rights and obligations on the other party, that's when we're effectively getting into the, I'm recognizing when resources are received, unless for another reason they are receivable, there is an obligation on the other party before those resources are provided to me. So a basic example, there could be a constructive obligation. An entity might have made such a statement that resources are going to be provided. It's gone beyond a statement of intent. It's like you've got so far down the line into resources that actually that entity really can't get out of providing those resources to you. So at that point, potentially you might say, okay, that's receivable. But we'd expect those to be quite rare cases.
Super. There are lots of questions about revenue recognition related expenses, which actually we will cover in a lot more detail in our revenue webinar next week. We've got a whole webinar dedicated to revenue. So I might leave some of those. But I would like to cover this one. Oh, where's it gone? Yeah, tax. So, and capital grants. I think this is a really key one. So if we've got capital grant and we're recognizing revenue, it looks like we have to recognize it all at once. And yet that might have tax implications. Can you speak to that point?
Yeah, so this is a tricky one, and it has been raised by a number of individuals, particularly in the practitioners advisory group. So in theory, a capital grant will be accounted for like any other grant. You will have rights and obligations under the grant. So either you've purchased a building, in which case I've purchased a building, you now owe me the resources for that, or say you're building an asset over time, the obligation is being met over time, revenue will be recognized over time. If that asset is then, that capital asset is then effectively yours, and there are no constraints, it's yours, you can do with it as you want, effectively that revenue is yours. That you have received in a lump sum a capital asset that you can do what you want with. We then appreciate there is that long tail of depreciation. So it would look in your income and expenditure account that you have a large surplus in 1 year, offset over multiple years by that smaller deficit from the depreciation charge. What we are looking to introduce in INPAG is a system of fund accounting, where if that capital grant has been purchased, say, with an enforceable grant arrangement that's connected to a specific project or program, you will be able to go and look in and see, actually, although it looks like I've got that huge piece of revenue in 1 year, I have my asset, and that asset is being used over time. So at the fund level, you would be able to see how that asset is being used. I do appreciate, though, from a tax perspective, a jurisdiction might look, depending on how that jurisdiction's tax arrangements are organized for NPOs, and say, here's a huge surplus that's going to be taxable. That is a practical implication that we need feedback on, because we need these guidance and standards to work in the real world, in real world jurisdictions. And if that is the kind of practice, we do not want accounting standards and guidance to be providing perverse incentives to not have those kinds of grants. But from the purest financial reporting and accounting perspective, if you've been effectively given a capital asset that's yours, you've got to recognize that revenue in year.
Brilliant.
So very, very mindful of it. Feedback be much appreciated on whether this is going to be a significant issue.
Thank you. And that brings me very nicely into basically to say thank you so much for all these questions and the types of issues and ideas that it's brought up. Even if we haven't actually answered your question or been able to deal with it in the time we've had, it's just really interesting and really valuable for us to see what the questions and queries are. It's very helpful. So I hope that you will share your voice. If you do intend to submit a response, please fill in the form, which is going to be shared in the chat. I know for many of you, reviewing and responding to public consultations about accounting standards isn't part of your day job. So we've tried to make it as easy as possible. Step one is to download a response template, which is in English, Spanish, and French from the website Have Your Say. You fill it in, you save it with your name, fill in your details. Then form your opinions by coming to the webinars, watching the videos, reading the documents. Then you record your thoughts, step 3, into the template, and step 4 is to upload it via the website. Looking ahead, Exposure Draft 3 is planned to be released in Q2 next year. The feedback will then be used to write the final guidance, which we expect to issue in 2025, ready for each jurisdiction to decide about adoption and use. In the next few days, you will receive a follow-up email with the recordings, the slide decks, surveys, and all the links that you need. So it falls to me just really to say thank you very, very much for joining us on this journey. All the different opinions, questions, views really are so valuable in enriching the conversation and helping us to improve the quality, the relevance, the consistency of financial reporting in our sector. I'd also like to give a final word of thanks to Philip Trotter, who's ably attempted to answer all our questions, and to others in the room, and for all of you for joining. Please do stay in touch. We will definitely, I'll try and record the questions and make sure we can get back to you individually as well. Bonjour, merci, gracias, Spanish. Thank you for joining us in other languages, and we look forward to seeing more of you in the coming weeks. We have 7 more webinars in the series. So thank you very, very much, and have a good day. Bye-bye.